Welcome back to The Explainer. Today, we're diving into one of the absolute most fascinating challenges in commercial real estate: underwriting distressed hospitality assets. We're going to completely unpack the step-by-step secrets to institutional turnarounds. So instead of just dwelling on grim historical financials, we're going to map out a realistic, highly calculated operational recovery. Think of this explainer as your treasure map for navigating the traps and unlocking massive upside in underperforming hotels. Okay, let's dive right into this. Here is our exact blueprint for today. First, the 20% return target. 2, diagnosing historical value leaks. 3, pricing the physical turnaround. 4, realistic ramp-ups and debt. And finally, 5, stress testing the exit valuation. Section 1, the 20% return target. That absolute goal, it's 20% plus. Look, in the world of distress hospitality, achieving a 20 to 22%, or honestly even higher, levered internal rate of return is the absolute holy grail. It is why we take on the risk. We are going to anchor all of our underwriting, all of our stress testing, literally every single decision we make to hitting this specific massive levered return. But actually hitting that 20% is uniquely brutal in this asset class. Why? Well, because hotels are dual-engine assets. You aren't just buying a passive real estate shell where tenants magically send you rent checks every month. No way. You are buying that physical shell combined with a living, breathing, 24/7 operating business. This dual nature means that underperforming hotels have incredibly complex operational drags. And if you ignore the business side to just focus on the real estate, that operational drag will eat your 20% IRR alive. Section 2. Diagnosing historical value leaks. Now, what's really interesting about this is how we actually prove a property is failing. We use the RPI, or RevPAR Penetration Index. This is the cornerstone of benchmarking against your competitors. Think of the market demand like a giant pie. If you look at a hotel's revenue per available room against its immediate peers, and that number is below 100%, is mathematical proof that this asset is actively bleeding its slice of the pie straight to the competition. Once we know it's bleeding, we have to put on our detective hats and find the root cause of the wound. During your KPI baseline audit, you're looking for 3 main culprits. First up, a capital deficit. This is your deferred maintenance, terrible curb appeal, or an outdated property improvement plan. Second is operational mismanagement. Think bloated labor costs, weak marketing, or just a really ineffective third-party management team. And third, a brand mismatch. Maybe it's a poor franchise fit or an over-reliance on online travel agencies that are just absolutely crushing your profit margins. Missing any of these during your initial audit will completely derail the turnaround. Section 3, pricing the physical turnaround. Okay, so underperforming assets almost always carry massive CapEx liabilities across 4 main buckets. You've got deferred maintenance for the big stuff like roofs and mechanicals, value-add cosmetic renovations to drive up your daily rates, and potential conversion or rebranding costs. But I want to draw your attention to the mandatory brand PIP. You absolutely must obtain official brand inspection reports to price this. And here is a crucial pro tip. Always buffer your estimates by 15 to 20%. Why? Because brand inspectors, they magically always find a surprise update you have to pay for, right at the last minute. Section 4, realistic ramp-ups and debt. Let's move to and see how this builds. Because instant turnarounds, they are complete myths. You have to model a phased 24 to 36-month timeline. Year 1 is notoriously messy. You've got the acquisition, the onset of heavy renovations, and a management transition. Honestly, revenues and occupancy will likely drop. Year 2 is about finishing those renovations and starting to claw back your market share. It really isn't until year 3 that you see true operational stabilization and actually hit your target comp set penetration. Because year 1 is so messy and the initial net operating income is so incredibly depressed, you absolutely cannot secure conventional high LTV senior debt right out of the gate. The math just doesn't work. Instead, bridge financing is your crucial stepping stone. You structure the initial funding with a bridge loan to cover the purchase and hold back a line of credit for all those renovations. Then, the entire strategy hinges on refinancing into conventional permanent debt around month 24 to 36, once the property is finally stabilized. Now, to actually secure that permanent debt, you must hit these crucial target metrics. You need a stabilized debt service coverage ratio, meaning your income comfortably covers your loan payments at 1.25x to 1.40x. You also need a debt yield of 10 to 12%. Beyond that, you have to underwrite a 4% annual reserve for FF&E, furniture, fixtures, and equipment, and benchmark your management fees at 3 to 4% of gross revenue. Listen, if you miss these targets, there is no permanent refinance. Your capital gets trapped, and that holy grail 20% IRR, it instantly vaporizes. Section 5. Stress testing the exit valuation. The final boss battle. So, the crucial point is verifying our treasure map's final destination. We validate the deal by targeting an unlevered IRR of 12 to 15%, which reflects the inherent turnaround risk. That, in turn, drives our levered IRR of 18 to 22% or more. We're looking for an equity multiple of 1.8x to 2.5x over a standard 5-year hold. But the real proof is your stabilized yield on cost. To ensure you've actually created real value, your stabilized NOI divided by your total project cost needs to land between 8.5 and 11%. Crucially, this must beat your going-in market cap rates by 200 to 300 basis points to prove you successfully forced appreciation. And speaking of cap rates, we have to be super conservative about how we exit. You must always add a 50 to 100 basis point spread above current market cap rates when calculating your exit valuation. You simply cannot assume you're going to sell the asset in 5 years in the exact same pristine economic environment you bought it in. This expansion conservatively accounts for shifting market conditions and the terminal aging of the asset over your holding period. And this brilliantly illustrates the ultimate turnaround rule. Renovation delays directly equal revenue drag and extended interest carry. So before you finalize anything, you have to stress test the pain points. What happens if stabilization is delayed by 6 to 12 months? What if your CapEx budget overruns by 25%? What if your average daily rate drops 5 or 10%? You have to aggressively model every single scenario to ensure your liquidity reserves hold up under pressure. Which leaves us with one final provocative question. Can't your turnaround model actually survive reality? Securing a 20% levered return is an incredible prize, for sure, but it requires a rigorous, totally unemotional application of this framework. If you don't properly diagnose those historical leaks, if you forget to buffer your CapEx, or if you fail to stress test your exit, the dual-engine nature of a hotel will completely overwhelm your spreadsheets. Thank you for joining me for this explainer. Now take this treasure map, apply it rigorously to your next underwriting model, and I'll see you next time.